The market is awaiting the latest interest decision from the Reserve Bank. This comes as the latest consumer price inflation ticked up slightly. At the previous Monetary Policy Committee meeting, a pause was decided after an aggressive hiking cycle which began in November and resulted in the repo rate now sitting at 8.25%. Well, our business editor, Xolani Mbanjwa, joins us now. Xolani, let's talk about consensus. Is there consensus on which way the repo rate should move, if at all?
Good afternoon, Hugo. If we take what analysts have been looking and delving into in the past couple of weeks, the consensus is that this time around there will be another pause. And moreover, it's because of what happened with the U.S. Federal Reserve last night, which also decided to pause interest rates. And they have been aggressive, just like South Africa has been as well. And if you look at since November last year, as we've been aggressively hiking interest rates to deal with inflation, we have been sort of following the path that the U.S. Fed has been taking. When they press pause, we press pause. When they increase rates, we increase rates. And surprisingly, when it was 50 basis points in the U.S., it would be 50 basis points here. So the consensus is there will be a hold on interest rates just because we've seen the inflation figure yesterday, that came in yesterday. It ticked up marginally 0.1% from 4.7% to 4.8%. But that doesn't mean that we might actually get a cut anytime soon, because it has come in between their target range of the Reserve Bank for inflation, which is between 3 and 6%. So the consensus is there will be a reprieve here. It's good news that we won't get another increase as households and businesses are heavily indebted, and we've seen these in the numbers from the bank financial results. There's a lot of impairments, bad debt, because households and consumers are finding it hard to keep up with the demands of their financial commitments.
Well, Xolani, we are moments away from that announcement, but the MPC met on Tuesday, I believe. So obviously they have come to a decision. What are some of the factors that they would have taken into account in arriving at this decision that we'll hear of in the next few minutes?
So the main point of the Monetary Policy Committee is to bring down inflation to that midpoint range. So one of the major things is that they will be looking at inflation, which is coming in at better than expected numbers. But it is also important to note that those who have this consensus about what's going to happen today also agree that inflation is going to tick up. FNB yesterday was predicting that next month there will be an announcement that it would have ticked up to 5.5%. So we shouldn't just look at inflation alone. There's fuel prices which are influenced by international oil prices, which have been aggressive as well. There is load shedding. There is also headline inflation, which has remained elevated, while inflation as a whole has also been marginally going down. But still, there are those warnings. So they will look at what's happening also with the rand and dollar strength. We've heard from the likes of HSBC saying that our rand is going to lose some steam. They are predicting that it might be 19 rand 50 by the end of the year. So the exchange rate is also important. Investments that are coming in, which in this instance they call them gross fixed capital formation, and they will also look at economic growth prospects. But at the end of the day, they are there to protect the value of the money that is in our pockets, and by doing that, they do that by making sure that inflation is down. It is not down to that level where they believe at this present moment it will stay at below 5%. So there are a lot of things that the Reserve Bank looks at, but the main thing that is driving inflation higher is our fuel prices, and we expect that next month, in October, we will, as the AA has predicted, we will see another major hike across all fuels, to be exact. So they are looking at all these major factors, and it's one thing that is quite important will be inflation, and to a much bigger extent inflation as it has to do with the hiking, the prices of fuels, and of course municipal rates that are also increasing that just came in a couple of months ago.
So for the lay person like myself, and I presume a few others out there who may not understand the fundamentals, the mirroring of the hike or lack thereof of the U.S. Federal Reserve Bank, how does that affect our position, bearing in mind that we may not have the same economic factors that the United States has here in South Africa?
Well, the rand still has to remain attractive as an emerging currency. And to make sure that it remains attractive to investors, you need to look at how the US dollar is moving. And with what we've seen yesterday, the rand, not only yesterday but in the previous weeks, the US dollar in particular has been becoming stronger and attractive to investors. And to keep the South African rand as an emerging currency attractive to investors, you have to at least, and this is not the only arbiter when it comes to these things, the rand still has to be attractive, and their mirroring of what happens in the U.S. Fed has to do a lot with the exchange rate, keeping the rand, even as one of the poorest performing currencies among emerging basket of currencies in the world, still attractive to some investors. So it's not a bad practice. In fact, I've said this before, Lesitshakganyago is liked for being predictable in the way that he always is when it comes to these decisions.
Finance 101, Xolani Mbanjwa, appreciate your time.